you're going to save yourself a considerable amount going off market, not paying, commission to brokers and so forth. But a lot of our deals come off market. We do, actively market and cold call and send yellow letters to go direct to seller. But we also have a good broker network, and we purchase through brokers and get those pocket listings, and that has helped us, as we've gotten to 17 parks now.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else. With your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, John Cohen. How we doing?
We're good. We're waiting here for a closing. We are selling a property, so fingers crossed it happens today, and we don't have to go into the weekend with a smile.
We'll see. I mean, it's still up in the air right now.
It is.
Right now, it feels good. Potentially.
I do feel good. I feel good. That could change in 30 minutes, or 30 seconds. But I think everyone's making strides to get this thing done. So let's see what happens.
I agree. It's been a long time coming. What's it been, 4 months now?
Yeah.
Over that?
January 15th went into contract.
January 15th. So, 4 months exactly, basically. So, it's been exciting. 30-month hold, give or take, coming to a close. I think it was good. We should do a recap episode one time, just talk about it once it finally does sell. But, no, I think it's interesting. But I'm hopeful that it goes through. Hopefully we have a nice weekend and kick off next week with nothing to really stress about too much. We'll go from there. But like you said, who really knows what happens?
Exactly.
But we do have an awesome guest for the next 45 minutes to an hour, give or take, depending upon how long it goes and or if we have to run and put out several fires to get this closed. But no, we'll keep it going throughout. But I'm going to let him introduce himself like everybody else because I'm lazy. So Andrew, thanks for joining us, bud.
Yeah, thanks for having me. Appreciate it, guys. I'm Andrew Keel. I'm in the manufactured housing community management business. I started out in Orlando, Florida, flipping houses and wholesaling residential contracts. Through that, I stumbled upon a couple of manufactured houses that were in a mobile home park. And I went ahead and bought them for dirt cheap, $2,200 for two, nice homes that were like 1995 vinyl sided shingle roof homes. And I didn't know what I was going to do with them. I was like, I just know this is a good deal. So I got on YouTube and I started typing in how to make money with mobile homes. And I stumbled across a guy named Lonnie Scruggs who wrote a book called Deals on Wheels. And he would buy mobile homes and then fix them up and sell them on contract to the end, buyer, end user that's going to live in them. And that was I was like an aha moment for me. So I did that with those two homes, had great success with it. I bought them both for $2,200, and then I sold them. One of them I sold outright for $7,000, and then the other one I sold for $3,000 down and $250 a month for 5 years. So it was fantastic, had me hooked right away. So I went ahead and did about 20 of those Lonnie deals. And through that process, I met a mobile home park owner, and he's like, hey, the real wealth is built through the land and the real estate and not the individual mobile homes. There's benefits through depreciation, financing. You can scale, larger and build wealth that way. So that was an aha moment for me. I got plugged in, became obsessed with mobile home parks. I'm a big goals guy. So I wrote on my refrigerator, my number one goal was to buy a mobile home park. Went to all the seminars, the boot camps, read all the books that I could get my hands on. And eventually, through marketing, I found a mobile home park, my very first one, outside of the St. Louis metro, and reached out to an investor that I had met through the MHU boot camp that I attended. And, he put up the money. I was the boots on the ground operations guy. We bought that first deal, and it ended up being a home run. 18 months later, we refinanced into some really good long-term debt. And, since then we've done 5 more deals together. And I've also done other acquisitions with other investors. We syndicate in about 2 or 3 deals a year. And, we now have 17 communities that we manage, and that's over 1,000 lots. So it's been an awesome run, and it's brought financial freedom to myself and my family. So we're really blessed and excited for the future.
That's amazing. So I'm jealous. I think that's one of the first times I've ever said that in my life. We have been banging our heads against the ground on the mobile home world for 2 years. I went to a mobile home boot camp. A buddy of mine called me up, said, I have an extra ticket. It was, I happened to be snooping around on your website. I saw, I believe we went to the same one. I don't know if at the same time or not, relevant. But a buddy of mine called me and said, you got to come to this thing. I got an extra ticket, come. So I said, yeah, you know what? Let's do it, right? What do I have to lose? Got on a plane, flew to Austin, went down there, touring properties in Austin, Texas. I looked at my friend. I said, I'm 30 years old at the time. I said, if someone would have told my 18-year-old self that I'd be touring mobile home parks in Texas, people would have put a different script on that template. Like, what are you doing in a mobile home park at 30 years old in Austin coming from New York? Yeah. But I left that event. I flew home, sat down with my partner. I said, we are buying mobile home parks. I mean, Chris was in the office. I said, these things are fucking great, man. They're great deals. Fast forward that, we own 2. We have a proof of concept 7-unit that I bought that it's already made its money back. It's a little deal. I mean, we just said, like, let's figure it out. And we have a 40 lot park. And the goal that I came up with was, I want to own, 2,000 lots in a year. And we've missed that brutally. But I love this space. When you fell in love with it, whether it was on that fix and flip or the boot camp or, touring deals, now you have 17 parks, and that's amazing. Can you speak to, getting out of the fix and flip world? Because I think a lot of people, that's their vision out of the box, and going over the mobile home park world, and was it the fix and flip on those 2 parks, or whether the flip on those 2 parks? What was it that, sort of said, this is where I want to be?
Yeah, there's really 2 things. When I owned those individual mobile homes and I was marketing them, to sell them after we had, put in some new flooring and painted a couple of them, we put them up for sale. The demand for those homes was off the charts. It was like insane. Literally the phone was ringing off the hook for the inventory we had. So, I knew demand was very, very strong. And it seemed like supply, if you have good, housing that was in good shape, supply was limited. So demand very, very strong. Supply also, when I learned about how it's very hard for a municipality and zoning to get a new mobile home park development approved, when I learned that supply was limited, it just seemed like, an Econ 101 home run. That's what you look for, right? So demand was very strong. They're not building very many new mobile home parks because it's very, very hard to get them approved, through zoning and all that, because it's a loss leader basically for the municipalities. From a money standpoint, if you have a regular mobile home and you have 2 kids that go to public school that live in that mobile home, it costs on average $12,000 a year to put a kid through school. And in these mobile home communities, the taxes that they're paying are very, very small. Literally, it's like the registration on your car. It's done through the DMV. So it's like $40 to $100 a year taxes that they're paying, but they have 2 kids going to public school that are $12,000 a pop. So that's why municipalities, amongst other reasons, a lot of people don't want to live next to a mobile home park, the whole not in my backyard deal. So it's hard to get them approved. So supply is limited. More mobile home parks are torn down every year than are developed. I think there's something I read about around 100 mobile home parks are redeveloped every year for higher and better use, whether that be multifamily, or some other use. And only about 10 mobile home parks are developed every year. So supply is shrinking, demand is off the charts for affordable housing. It just was a great fit, and I decided to just become obsessed and go all in.
That's it. So that's awesome. And obviously I put the 2 thumbs up. Sidetrack, I just confirmed the wire instructions for our closing. So that's got to be a good sign.
Hey, congrats, man. That's awesome.
But
let's get the money first.
Exactly. Right. I tell you, hey, even when we get the money, it's got to clear, and I got to be able to take it out and use it before it's closed. But I think what you touched on, I think, is the most important. Why my eyes lit up when I went with my friend it was the supply and demand factor, and the overwhelming amount of mom and pop ownership, right? Because the space that we're in, we compete in an extremely competitive environment, not only with mom and pops, but with professions and institutions. And, we were speaking yesterday about that $20 to $50 million deal. They're great. We've done them. We own a couple of them, but there's probably better opportunity in the $2, $5 to $12 million space. And the mobile home side, when I heard that stat, like you said, hundreds of them, get demolished a year and go away. There's only quote unquote 45 or 50,000 database mobile home parks that they have record of. You're losing 100 and really nothing's getting developed. And the stuff getting developed today is very, tiny home-esque. It's very unique, which is a whole nother product, which I think is really cool.
Community.
So that's supply and demand, bottom line in any business, right? Supply and demand. Last bottle of water, you need it. You're going to pay me for it. And when you go to the mobile home space, that supply and demand gets like a gasoline added to the fire when there's no such thing as affordability anymore in this country. I mean, our C-class apartments rent for $900 a unit. That's a very expensive rent to the median income of this country. So when I heard it, I got super excited, and I went pedal to the metal, and I went about it the wrong way, just not really putting the right systems in place. But that supply and demand thing was the thing that just got me excited. You took better action. I took, I'm a bull in a china closet, so it takes me a little while to get going. But no, I think that you nailed it. I think anyone listening here, that supply and demand factor with the affordability component, that's why my eyes lit up. So I think that's super interesting, and just that's what got you going, which is exciting.
Yeah, I mean, that's a big part of it, and then also the mom and pop deal that you touched on. I think it's about 80% of mobile home parks in the country are owned by mom and pops, meaning that they've owned them for a long time, usually 20, 30 years, and they have a lot of equity in these things. So they're more flexible when they decide to sell, which during the next 5 to 10 years, a lot of baby boomers are starting to retire, and they want to sell these assets. So they're more flexible. They're willing to offer, financing and terms on the sale of these assets, and you're able to just pick them up with, easy upside. A lot of these mom and pops haven't raised rents with the market. They haven't, made occupancy at the top that it could be, because, to them, if they don't owe any money on it, the last thing, usually the pop is the guy that was doing the rehabs. A home would go vacant. It needed some new carpet and paint. He would do that himself when he was younger. Now that he's 75, 80 years old, he's not doing that as much. So he'd leave the home vacant. And, as vacancy gets down towards around 70, 75%, they're still cash flowing. They're still making money because they don't have any debt on it. And, when we come in, we can buy these assets, optimize them, through filling vacant units and raising rents up to market. And another big factor that we do is we bill back for water sewer expense. A lot of these parks are master metered, and the park just includes water with rent. So we can come in, use a system like Metron Farnier or ABT, and put individual meters, sub-meters on all the homes, and start billing them back for their usage. And, that is a huge way for us to increase NOI. And, we build up to a refinance point, pay back all our investors their initial capital, plus a great return. And then our plan is just to hold these things long term. We think the value and the cap rates on these are just going to continue to drop as the supply gets more and more limited.
That's why, like you said, like when I first bought my first apartment complex, we sub-metered it, right? And the value add component 7 years ago, that was being done, but or billing back water. But a lot of older landlords still, they don't do that. It's like, give me $800 and they just pay all the expenses out of that. And the new switch is that. So it's the low hanging fruit is so easy to grab. And a lot of states, when I say regulations, there's nothing wrong with going in there except for maybe the personal side, but there's nothing wrong going into a $200 lot rent and raising it to $400 like that. Cause a lot of month-to-month tenants, you have so many things that help you get your income up so quickly. Now, yes, right, wrong, indifferent, truth serum. Is it right to take someone's rent and double it? No. Can they afford it? Maybe, maybe not. But a lot of the time the tenants living there, no, they don't have a choice per se. Where are they going to go? Their rent's going to be higher. So you have such wiggle room. Is there, in your mind, when you look at a deal and you see that, do you guys have any thought about that? Like, hey, we're not going to push it that aggressively, or more often than not, you have to make a living too for your investors, for yourself. Do you guys have anything that you speak about there? Because I know that, the boot camp I went to, people protested there. I'm sure they might have done the same if you went to the same one. But people think that raising rents like that is ridiculous. But if the market rent's $500 and you're charging $200 and you raise it to $400, that's still a good deal for those tenants. But can you speak to that? Because that happens so frequently that rents are so low that there's just so much upside right there alone.
Yeah. So in my opinion, raising rents $100, $200, in a single year is a little bit excessive. I think more than a little bit. That's excessive. So we've never done that, and we don't plan on doing that. I do know some other bigger operators that have, gone that way with their rent increases. But where we find a lot of our value add is through increasing occupancy, bringing in homes, and then, doing modest rent increases, right? Over a few years as we execute our business plan. That has been, very powerful for us. But I also own my own mobile home transport company. That was one of the pain points that I noticed early on, is that I would have to rely on a third party to stick to my schedule, and it was delaying the speed at which we could execute our infill plans. So now my driver, the toter truck, moves into a park, lives on site, and buys mobile homes and brings them in, and they install them and everything. So we can control that process now, and we gain more value add through that process than trying to be more aggressive, I would say, with our rent increases.
It makes sense, right? Like if you have, let's say, 75% occupied property, 25% of your lots are vacant, you can raise your current tenants 200, or you can fill a lot at 300. And it does the same thing without causing an uproar at the park, which would be the approach that I would probably take as well, because your occupancy alone and billing back water, those two numbers are big numbers to the bottom line of a park. So you don't necessarily have to go up, and uproot people's lives. So it makes a lot of sense. I know there's a lot of people that don't do it that way, which, I'm not going to tell someone it's the right or wrong way, but I happen to agree with that, is that component. I know another thing in the mobile home space that is a big question mark for a lot of investors, a lot of operators and owners: utilities, public, private. Can you speak to that? Are there any, what are you seeing? Because, you own 17 parks, so you probably got a mixture, and or you have a criteria that you won't deviate from. But can you speak to some of the pitfalls to private utilities and public utilities, or maybe explain a little bit for anyone that doesn't understand those two components of a mobile home park?
Definitely. That's a great point right there. A great question. So utility infrastructure is one of the most important things that we inspect when we look at a new acquisition. Typically the best case scenario is public utilities, city water, city sewer, that's billed to the tenants, and the tenants are paying for that usage. In other situations, there's private utilities like septic tanks, wastewater treatment plants, lagoon systems, well water. Those would be private utility setup, and there's more liability when you're in charge of being a water provider to a a small community like that. And also with your sewage, there's EPA requirements. There's more liability and more cost. Ultimately is what it amounts to. So your expense ratio on private utility parks is going to be higher, obviously, usually around 40% of gross, where on a public utility property, the utilities are around 30%. Because with a wastewater treatment plant, you're going to have a certified operator, and same thing with your well. You're going to have someone come, read the chlorine readings and keep a log of all of the chemicals and so forth, and the levels of those. So more complicated. We prefer public utilities. That's the majority of our parks. I think we only own 3 communities that have private utilities, and 2 of those have septic tanks, and 1 of them has a well. And luckily we have good boots on the ground partners that are our processors and our operators for those systems. But yeah, I mean, our lateral lines in the parks, we have septic tanks. A couple times a year, we'll get a call that there's some root intrusion from the local trees that have gotten into those lateral lines, and they need to be replaced. And that usually costs around $3,000. So you have to have extra reserves because you're responsible for more. But if we had a city sewer system in that park, the city would be responsible for maintaining those sewer lines. So you just got to know what you're getting into. And the MHU boot camp does a great job of kind of explaining that and going into the different utility infrastructure details.
That's awesome.
So I have a question. I want to change gears slightly. You touched earlier on the supply and demand, especially with cap rates and people coming in, which I think is a really interesting conversation because 5, 10, 15, 20 years ago, mobile home parks have changed from an investment perspective, from something that, like you said, was probably 95% owned by just individuals, one-offs, and it's changing very, very quickly. How has it been like for you the last couple of years as more and more institutional money has come in, more sophisticated investors have come in, deals that
idiots
are
like
being
me have come in.
Yes, idiots like John have come in. The rise of these online resources to teach people, the boot camps, just, the more attention that it's gotten invariably is going to drive values up, drive cap rates down, compress yields, things like that. How have you combated it? And then also, what do you see going forward?
Great question. So demand for these assets has definitely taken off. There's a lot of new articles coming out about institutional money coming into the space. Like you said, there's these boot camps and training seminars teaching people how to get into the business. A lot of people from multifamily that are seeing cap rates as low as they are over in that field are looking for higher yields, and they're coming over and getting into the space. So demand is definitely increasing. From my wholesaling days and fix and flip days, I was always taught you go off market. You're going to save yourself tremendously. Every deal is different, but you're going to save yourself a considerable amount going off market, not paying, commission to brokers and so forth. But a lot of our deals come off market. We do, actively market and cold call and send yellow letters to go direct to seller. But we also have a good broker network, and we purchase through brokers and get those pocket listings, and that has helped us, as we've gotten to 17 parks now. So that I guess would be my answer is, whenever you can, go off market and go direct to the owner with your marketing for these assets. But a lot of the parks that are 100 lots or higher are getting, gobbled up right now. That's really because these big institutional buyers, they have large amounts of money to spend. And for them to come around and buy a 50 unit or a 30 unit mobile home park doesn't move the needle for them. So they need those larger assets. And those are the ones that are really, the cap rates are getting really low and getting very competitive when you try to purchase those. We've been very fortunate. We're kind of flying under the radar. All of our properties are between like 30 and 90 lots. I would say. Like that's the majority of our properties are in that range. So we're kind of flying right under the radar. In properties moving forward, we don't buy any that are smaller than 50 lots. So we want to buy in that 50 to 90 range. That's our business plan, that are about 70 to 75% occupied. We want to come in, value add, build back utilities, fill it up, and then refinance as quickly as possible. The rates being so low right now, we get some very good debt. We just did a Fannie Mae loan on one of our properties in Tennessee. Non-recourse, 10-year fixed rate, 3 years interest only. There is very good debt available for manufactured housing communities, as there is for multifamily and other asset classes. So we're really excited about it. And, there still is opportunity here, because not all of these baby boomers are selling their parks today. They're going to slowly release these over the next 5 to 10 years. But I do think that now is a great time to get into this space as they do start to release those assets into the marketplace.
Yeah, I think it's interesting because there's basically a direct parallel between the conversation John and I have been having the last week or 2 weeks for the multifamily side of what are we going to target, what are we looking to purchase, and it's the same conversation, just slightly different. Of over $20 million, $15 million is when you really start getting into that same institutional space, 300 units, 250 units, etc. So we've just said, like, we'll just target $5 to $20 million deals, and that's the last couple of deals we've done have been right in and around $10 million bucks. It's not like, I think what the last deal we did that was larger than that was probably River City, right? Everything else was at 10 million or less, right?
Yeah, Whispering Highlander, small. Park
Aston Villa,
Hartford
was 10 million.
Kimberly.
Yeah, they're all
smaller deals, and we've done really well in that space because we're I don't want to say we're taking an institutional view to a mom and pop space, because it's not true, but I think that you're competing better in that space, which is why, same thing on the mobile home side, I wanted to take that same approach. It's, let's go buy smaller parks. You won't have that competition, but it can't be too small because it doesn't make sense. It's difficult to make money on those deals, but I agree. Yeah, I think, and that's what we were talking about yesterday, just, tweaking that business plan going into what may be a recession. Who knows? Like, we don't know yet. What can we really be efficient at buying with a really good approach to it, where we could be a little bit different than, the herd.
Yeah, that's where the money's made, for sure.
So how are you looking at buying deals going forward? I know you just talked about 50 to 90 units. What other sort of things are you targeting, and for what reason?
Yeah, so 50 to 90 units, public utilities, obviously to keep our expenses low. We also target properties in the Midwest. We've found, strategically, that the Midwest is a great place to invest in. It has slower growth, but you can get properties there for a lot cheaper, that are of better quality than properties in Orlando, Florida, where we're based out of. We also have found that the stigma of living in a mobile home is not as strong in the Midwest compared to other parts of the country. So it's more mainstream for, a newlyweds to start out in a manufactured house and, save money so that they can, buy their own house someday. So that's part of our strategy as well, is buying in the Midwest, buying at a certain level, and then sticking with the public utilities when all possible. Also, we have a nice portfolio that's based in the Midwest, so we're able to cluster and build scale with our operations as we acquire assets in that area. So those are a few reasons why we like the space and why we buy where we buy.
So
go ahead.
I was going to say, I think self-serving, and I think a lot of people listening would like to hear it. When you buy like that, because you're in Orlando, and that's why one of the problems we had is, we're based in New York, so I wanted to keep it to the Northeast, and there's all different reasons why it doesn't make sense anymore. But you're in Orlando buying in the Midwest. How frequently do you travel to your parks? What type of systems do you, for quality control and or operationally? Because, I know a lot of our deals on the multifamily side, third-party management it's what it is, right? And it fits for a certain unit count. Is there a size property, or what do you, I won't buy a 30 lot park unless I know it's 50 or more now, but is that 50 that number to really operate it efficiently? Or, as long as it's within an hour of another park, I could set it up. Can you speak to those points? Because I think that's, a very big part of this. It's more hands-on operationally, I believe, than some other product classes. So I think people will have to know that. And speaking from someone that owns 1,000 lots, which in the mobile home world is a lot, how do you operate that really well?
Yeah, great questions. So we have our own management company, and you got to gain scale. So owning 30 lots, you're not able to afford an on-site manager in that community to be your eyes and ears, because it's a very part-time job, and the revenue coming in won't support having an employee there. So on properties that are 50 units or higher, you're able to give the on-site manager a healthy wage to be your eyes and ears, your point of contact. And those on-site managers are the lifeblood of the community. A good community can turn into a bad one really quickly if the on-site manager is not doing their job and issuing violations, if people are trashing their lots, and if people aren't paying. We're in a collections business just like you guys. We got to collect rent, we got to issue notices on time, and if those don't happen, we're not gonna be successful. So we have on-site managers that live in all of our communities, and they, help us. They're basically our eyes and ears. We have an off-site, corporate team that works, out of Orlando here, and then we have a regional manager that's out of St. Louis. That between myself, my head of operations, and our regional manager, we each visit our parks. One of us visits the parks every quarter. So every 3 months, we're getting inside of these properties, doing a drive-through, looking for liability hazards, looking for violations, and, looking for improvement points. So that's a real baseline view of our operation. There's not a ton of third-party management companies that you can go hire to manage a mobile home park. They're just really not built for it because it's more hands-on. We tried it with one of our communities in Indiana, and it crashed and burned. It didn't work out. It was very high. How do you put this? It was just, there was a lot going on, and they couldn't keep up with the demand. Typically there shouldn't be a lot going on. There should be 4 to 5% turnover annually with our tenant-owned homes, and it should be very low maintenance, because our business model is not to own the mobile homes themselves. It's just to own the land underneath of them. So if there's an AC unit that goes out or a roof that needs to be recoated, the tenants need to pay for those to get those maintained. And with that, there should be a little going on. But during the infill process, when we're bringing in homes, we're selling homes, we're improving the park that we just bought, hiring a third-party management company is very difficult, because you're entrusting them versus a boots on the ground person that's there every day to give you feedback on the property's performance. You don't find a lot of third-party management companies. And it is very, very hands-on, so that's a good little background for you.
Awesome. Yeah, I think it was interesting too, when you touched on the stigma part of it, because I think that probably does play a big role in a lot of not only investors' minds, but just like what this entails, because, I'm sure a lot of people think of manufactured homes, they go, oh, a mobile home park or a trailer park, and then they think of the stereotypical like 8 Mile, like from
Trailer Park Boys,
exactly. And that's does that exist? Of course, but so do D-class apartments, and none of that's not what we invest in. There's all different levels, and there's manufactured communities that you wouldn't even know they are. You would think they're just single family homes. You would have no idea, because they're beautiful, they're brand new, the interiors are great. I have a relative that lived in one out in the Midwest, and you'd never know unless you actually knew. And what does it really matter at that point? It's just you don't own the land. So I think people's perception of what it is just off from reality, because if you're not in it and you're not exposed to it, your only exposure is through what the media portrays, and it's just not an accurate representation, or it hasn't kept up with what has been going on the past several years as people have bought these things and, put some money into it. Have you seen like that be a trend? Like as this has become more popular, has like the overall quality of parks been steadily improving in your eyes so that the perception of these is changing? Or is it just, there's always just been a misperception?
Yeah, I think it's a slow process. And, like we said earlier, like 80% of these mobile home parks are still owned by the mom and pop owners that are not really reinvesting in these assets. They're trying to pocket as much as they can out of them. Mm-hmm. So it's slowly starting, but the stigma still hasn't changed. It's very strong. And I have a funny story about that. My very first deal, I was looking to, for a partner to bring the money to do the deal. And I set up a lunch with like the richest guy my family knows, right? Like this guy like has the Ferrari, he has the beautiful house on the lake, like this guy he's the richest guy my family knew. He luckily like coached my little league basketball team when I was a little kid. So I went and met with this guy at a nice place for lunch, downtown Orlando. And I had a whole business plan, a pro forma for this mobile home park. And I said, hey, look at these returns. They're like 25% plus returns on this park near St. Louis. And I'll never forget what he said. He said, Andrew, I love you, but there's no way I'm investing in a trailer park with you. It was just the instant stigma of like, buying a trailer park that really turned him off. And it wasn't something sexy that he could tell people at the country club that, hey, I invested in a trailer park. But that deal, ended up being a home run with the guy that did investment with me. And, we were able to turn it around in 18 months. And the total return was above like 150%. So the stigma's strong. I think it'll be a slow process. But if you look at the communities that have been, reinvested into and the deferred maintenance has been taken care of, they're slowly starting to improve and to, really become nice assets that people enjoy living in and are well taken care of. So we're excited for that as that process continues to happen.
And to piggyback off of that, we're actually, after this, I actually have a call with the girl that works for us, spearheading the acquisition side. We're buying a deal, 88 lots, public utilities, 42 paying tenants, 22 tenants that have a delinquency over 5 years. They haven't paid rent in 5 years. So,
oh my goodness,
the guy wanted at first a price, and I said, okay, it works. Then we got the reports, and I'm like, dude, like, it ain't gonna work. This property is rough. I mean, it's banged up. They've ran it into the ground, but. Then he said he'd only finance us. And I was like, okay, let's, but I said, you can't even own or finance this. There's nobody paying rent in this park. So we're now negotiating a lease to own option. The guy's only making like $14,000 a year in the park. So I said, I'll give you $14,000 a year for 2 years and let me turn the park around. And he's like, you do that for me? Like, you're going to basically just turn it around and then sell it to me? I was like, no, I'm not selling it to you. I'm going to turn it around. You're going to get your price you want because it's going to be worth significantly more. And he didn't even know. He had to call his lawyer while we were on the phone call to say, is this like a real thing? And the lawyer's like, yeah, no, this happens all the time. He was thrilled that we can do it. But the stigma, I mean, when we first drove through this thing, I was like, oh God, what am I doing here? Like this is, I don't want to say dangerous, but, and that was part of a tour in March of 2019. We toured 15, 16 parks, and the stigma, no one's helping the stigma, and it's the long-term ownership that they're just not reinvesting the capital because there's no need to. Like you said, there's no debt, there's no requirements, there's no one coming out to check on it. So the excitement from my side of stuff that you touched on, there's just the upside seems to be, you can see the light at the end of the tunnel by just going in with some capital, and that's the part that's intriguing because I joke around all the time. The multifamily deals we own are extremely well run and extremely well renovated. I'll pat myself on the back, but these are not the properties that I'm driving my friends to, right? Like I'm not, they joke around all the time. Like a joke is like, oh, there was no rape or murder today. It was a good day, right? Like that's an aggressive statement, but the properties we own aren't the sexy Class A 5-story new construction or elevator buildings, right? Like when we drive past our properties, if I'm an investor, I'm like, that's not it. Don't look at that one. That one's ugly because, they're not the the bragging properties. And that's where the, investors like that. And a guy like that, and I have a ton of investors as well. They're like, I'm not buying a mobile home park. It's just not, no shot because they still feel 8 Mile-esque or, all these, cops and all that stuff. And it's just not the case.
Yeah. Yeah. But, with these properties, starting to be owned by new owners and institutional owners, I'm optimistic. I think that these properties will be turned around and we will provide more affordable housing units for the country that desperately needs it. So I'm excited for the future.
So I have a question because that's interesting too. We were talking earlier about, there's parks with 200 rents and you can push them to 400 or 300 or 150, whatever it may be, or even higher. Because there's dwindling supply and increasing demand for affordable housing, is there the fear that these things are just going to stop becoming affordable, similar to the way John just alluded to with a lot of the C-class apartments where, because investors are trying to come in, cap rates are compressing, they have to work harder to squeeze value out of it. Like you were saying, we can buy a park and we could push it 200, but we won't because we'll focus on the occupancy and the water sewer. Well, does in 2 years, all of a sudden now somebody say, well, cap rates came down from, an 8 to a 5 or an 8 to a 6 or a 9 to a 7, or, as cap rates come down, am I now forced to, as the investor, to make this park work, squeeze every ounce out of it and rents just keep going up until they're unaffordable? Is that a conversation people are having? Am I overthinking it? Is that something you guys are thinking about as well?
Yeah, no, I think that's a great question. At the end of the day, Class C apartments are our competition, right? Mm-hmm. And we want to remain at 50% of whatever Class C apartments are charging. So if you guys are charging $900 a month, we don't want to go over $450, we don't want to go over $450 a month. So, that's the end of the day fact is that we're still competing with, our tenants could go rent an apartment, but we're just so much cheaper than that option that it's a no-brainer for them to, not share walls with someone and, have their own yard and, be able to park right outside of their front door. Mm-hmm. There's some benefits to, manufactured housing versus apartments. So, I think you just have to look at both options, but, I don't think that they will get unaffordable anytime soon because, there's always apartments. That's an option.
And then I feel even to that point, even if it's not 50%, right? Let's say a mobile home is a 3-bedroom more often than not, or a 2-bedroom, right? Like, if you have that 3-bed, 1-bath, or a bigger mobile home, it's probably going to be bigger than most apartment communities. So when you look at it, yes, it's nice to be 50% below. Same thing, we buy apartments, we want to see at least a 30% gap between Class A, if not more, because then you're like, well, they're definitely not going to go into a Class A building. It's less space, whatever. But the other side is I don't have to share a wall. I can park in front of my house. I have a yard. And that gap, I think it'll always be there, right? I can't take inflation out, take all that stuff out, but I can't see a mobile home park getting to where it is in the market being equal to a Class C rent. And even if it is equal, you could probably make an argument that, living in a mobile home park, it's different, right? Someone that's going to live in an apartment is going to live in an apartment. Someone that's going to live in a mobile home park or a manufactured community, it's different. But I think when you look at the average home prices in an area and what they rent for, and then an average apartment complex, there should be a good buffer amongst all of them that can steer people even in that value add, even as more people come in, even as more money gets invested. I still think you'll have that gap, at least in my opinion. That's my take on it too, because it's a question I don't think I've heard anyone ask. Is it good? With all these people coming in and raising rents, when does it stop? But I think there's still going to be, even with all of that happening, you still got a good cushion before you approach that next product class. And the amount of money that you'd have to put in to get to that next class, what's being done in the mobile home world that I've seen is people are buying them, knocking them down, building multifamily, or, changing it completely because they say, wait a second, I could buy a piece of unentitled land for $20 a door, I could build 200 units. I could buy this park for a covered 4 cap. I'll make 4% for 5 years while I go through planning, zoning, and development, wait for the market to shift. I've made a couple dollars. Now I'll go build it. And it's a whole different competition in the future. So I think that will always be the buffer between someone coming in and just blowing out the space, because it probably wouldn't make sense, in my opinion.
Yeah, that's a really good point. So I agree with you on that. There's always higher and better use at some point.
And I know there's people in the mobile home, they want to be 30 miles from a major MSA, a Raleigh, a Durham, and, 30 miles from a major MSA. The play there, those deals are going to sell at 4 caps and 5 caps and 6 caps, lucky if you get a 6 cap, because those people are selling those deals as future developments. It's, you're 30 minutes from Raleigh. It's a ridiculously growing market. So, that's some of the other benefits to like the Midwest, right? You're not going to have that exponential growth to compete with the deep-pocketed investor that says, I'll take 4% for 3 years before I put a shovel in the ground. So I think that's another layer there, which is, maybe you have to go 45 minutes outside. Maybe instead of a 1 million person MSA, you do a 200,000 person MSA. So those components will probably steer some of that capital.
Yeah. No,
so
I
quick
agree.
question, because I think it sounded like you mentioned something interesting. That quote unquote 50% below Class C rents, is that like a good quote unquote rule of thumb that people should keep in mind as they start digging into this stuff, or is that not really applicable like across the board?
No, yeah, that's a actual measure that we look at when we're in due diligence, looking at the demographic data and what lot rent comps are and apartment comps are. So that's a good measure. Some of the other things we look at is like a metro with 50,000 or more population, looking at an average home price of 100,000 or higher, and looking at an average home income above 40,000. Those are some measures that give us an idea of the type of tenant class we would be dealing with in that market.
So that's awesome, thank you. So when you look at that 50% below apartment rents, is it that 50%, is that just lot rent, or is that lot rent plus what it costs them to finance the purchase of the home? Or
that's just lot rent.
Okay. Gotcha. I wasn't sure because I know, obviously homes go for different prices. They get different debt on it. Payments are different. I wasn't sure. Do you guys then factor that into the cost for somebody to ownership versus other stuff? Or because it's so variable, it's quite frankly very tough to even calculate and compare to a rent?
Yeah. I mean, we don't really calculate that in, but that's like the top of the market for lot rent is 50% of
Right.
your Class C apartments. So, we're not buying them at that lot rent. They're a lot lower right now, but there's room to grow, with consistent, annual increases. But
and even the financing component, right? If the lot rent is one component of, the mobile home, what I realized that there's like 17 businesses in one. You have like the lot rent component, the park on home component, there's a lot of moving parts and a lot of levers to pull. But if someone's going to buy a house, that more compares to what houses in the area sell for. Because if they can get a mobile home park for 30 grand, 50 grand, 17, whatever it is, that piece, how that compares to can they go buy their own stick-built house, right? And that metric is probably something that, I don't know, you look for a lot of tenant-owned homes, but in an area where you're going to bring in homes more often than not, you're either going to buy the home, bring it in, or use a 21st to finance the home, something like that. But the metric there you probably want to look at is, what homes sell for. Because if they can go buy a stick-built house for 30 grand, the mobile home world's probably not going to work, or it's going to be a totally different community. So I think that's the component there. And correct me if I'm wrong.
No, yeah, that's 100%. You're accurate there, because you could buy a brand new manufactured home from the factory floor for around 30 grand, and then if the average home price is 30, 40 grand, stick built, that's going to be a better option for you. So that's why we look at the average home price, and we want those to be 100,000 or higher, which is very common in metros that have 50,000 population or higher.
Awesome. I love it. I think that's a fantastic place to wrap up. Andrew, thank you so much for coming on. I think gave people a ton of insight, some good stories, experiences, stuff like that. I definitely picked up a few things. John doesn't tell me shit, so it was good to have somebody on who actually shares. For anybody who wants to get in touch with you, learn more about you, follow along, where can they do all of that?
Yeah, if anyone wants to reach out, either as a potential investor or a JV partner that can help, source deals, please check out my website. It's keelteam.com. That's KEELTEAM.com, and schedule a consult to chat with me, and we can go from there.
Beautiful. And for anybody listening, we will have that in the show notes in case you didn't catch it. If you guys are not subscribed to the podcast, would really appreciate it if you guys would do so. It would mean the world to John and I. If you already are, please send it to a friend, colleague, family member as well. Word of mouth is kind of how we've been spreading this thing around, so we would appreciate it. Andrew, once again, thank you so much for coming on. It was amazing.
Thank you, guys. I appreciate you having me.
Thank you.